Hi, JB Cycles here with another weekend video on April the 13th. So, yesterday's video on the S&P was not my best video. I had too much information and, well, it got kind of messy. And also I have looked over my bear market scenarios once more, and I have kind of changed my mind a bit. Not very much, but yeah, there are some details we have to look at. Because what I am seeing is we have a pattern of two 17-week cycles, and that's the first part of a bear market, and the target for those two 17-week cycles is the 3.5-year average here in purple. And now a typical pattern here would be, you see, this one almost made a double top in 1969, but we ended up at 3.5-year average. Then we tried to bounce, not successful. So we tried to bounce off it. Was that enough? Was that just a short bear market? And no, it wasn't. We got, a real breakdown. And if you go to the next one, 1973, again, the first part of the bear market, that's a ABC move, consisting of two 17-week cycles. The target is down here at the 3.5-year average. Was that it? We tried to bounce away from it, but that failed. Now we also have some other outcomes, like this one. Here you see actually support did not hold. The target here was the 3.5-year average, but we went deeper. So here they didn't even manage to find support at that level, but that kind of had a bullish outcome, because then you got the capitulation right away, and then it's all over. And similar in 1962, you see we have the ABC move of two 17-week cycles. The target is at the 3.5-year average, but it didn't hold. We just capitulated, and then it was all over, and it was bullish. So if we look at the 2000 the year 2000 top, again we have an ABC move. It's a bit messy, the actual S&P here, but it is two cycles of 17 weeks, and the target here, is the 3.5-year average. And actually you see the target, or the support, didn't hold. So at that time you could have asked, is that a capitulation? Is that a bullish setup? Is that it? But you see now the 3.5-year cycle, the 3.5-year average is resistance. There was a bull trap above it, but it failed and we went down. So again, we had the same thing, just it was just now it broke down and then met resistance, couldn't break it, and we had a much worse bear market. And then we have this one, 2007, 2008. Now this one was, a bit shorter, but still it was as the other ones. This is two 17-week cycles, and the target is down at the 3.5-year average, went a little bit below it, but roughly the support held. But then, could we rally off? Was that just a soft landing? Are we entering a new bull market? No. And we crashed out really bad. And then we have 2011 again. We have two 17-week cycles. This first one found support around the 200-day moving average. Then we broke down, and the target, the 3.5-year average, and that's it. And we rallied. New bull market. Now we have similar in 2015. We have two 17-week cycles making a sideways ABC. So it was a range bound sideways ABC, and the final move down, you see, it found support at the 3.5-year average. And then all over and bullish. Now this one did not quite follow the rules, so I'm skipping that one. But if we get to the previous bear market, again we have an ABC consisting of two 17-week cycles. We did not quite meet the target here at the 3.5-year average, and then we had a bit of an unusual pattern because we fell back and tested that support once more. Normally I would have interpreted it as a failure. We should just have crashed down, but we didn't. You see, we can actually test that support even once more. And what does all this mean for the current situation? Well, we are, as you see, we are in the first 17-week cycle going down in this. This bear market could possibly end around September. So we have to make an ABC into around September, and the target is the 3.5-year average. It's close to the previous bull market high, and how will this ABC move be? We almost met the target already at the crash last week. So, we could almost make a double top like 1969. But we should be in a downtrend into around September. And then, I am expecting a failed rally around Christmas this year, January, sometime in the winter, and then a real breakdown in 2026. Now you could also, maybe because we have started this bearish, maybe it could be a little bit more like 2001, 2000. Maybe we could break that support around September, October. Well then, then you get the question: is that a capitulation and bullish, like the 1960s? We could just, it's all over and we rally, or is it bearish like year 2000? We bounce up and we can't break the resistance at the 3.5-year average, and then we crash down. Well, I would favor that rather than saying this is a quick crash capitulation, then all bullish. But we have to see. So we could break lower in the fall, but the first and primary target is the 3.5-year average. And in my opinion, a bullish outcome here would be something similar to 2015. If we manage to rally almost back to the all-time highs, and then we drop down to make some kind of a sideways range bound ABC, a big double low, something like that. That would be a bullish outcome. So the big bounce, I was talking about a big summer bounce. Well, that could still be, that's the B move here. But normally when I'm referring to the big bounce, that would be this one, after we had met the target, and then we hope it's all over, and we have a big bounce, but it's failing, and then we crash. So we will have to look further into this in a later video. See you!